Hey traders, Akil here. Welcome back to another episode of the Trading Edge video, the weekend edition. If you guys are brand new, this is a weekly video that I put together sharing you the best trading opportunities that are on my radar for the week ahead. However, with that being said, this week's going to be a little bit different because, well, honestly speaking, aside from the pound dollar, there's not too much on the radar. So instead of wasting your time and just, spending 10, 20 minutes talking about stuff that's not going to be purposeful, I decided that I want to give you guys some value, and we're going to do a little bit of a lesson on trade management, risk management, and the benefits of doing so. And the idea stemmed from an email I recently received from a trader that I worked with. He said, Akil, I hope you and your family are safe and well during this time. What a crazy world we live in, right? March has been certainly an interesting month. I'm in the US, so March for us is when the corona outbreak really started to kind of hit. I don't even think it's at full force yet, but it's there. It's concerning. But he says, I wonder if you would be able to give me some comments on how I could improve my trading from my first quarter of 2020. I went live around September, October of 2019, and my gains are 57% since then. First and foremost, well done, sir. 57% in a year would be an incredible return. 57% just from a few months is incredible. So hats off to you on that. He said, I followed your instructions of reviewing my trading every quarter and then look to add funds. And something that we talk about a lot is when we're working with traders through the developmental process of becoming a trader, we always tell them to not only treat your trading like a business, but treat yourself like a business. Imagine yourself as the owner and operator of your own prop firm. And when you join a prop firm, you just don't get handed a bag of money at first, right? You have to kind of earn your keep. So you get a small amount of money, kind of a teaser, said, hey, here's a little bit of cash. Let's see what you can do with it. And then as your performance, as your performance maintains, increases, all depending on what the standards they have, you get rewarded with more money. So we always talk about doing quarterly reviews with our traders just because, I'm a sports guy. So everything for me is like in quarters: first quarter, second quarter, third quarter, fourth quarter. But taking that time to do a review and also allowing yourself enough time to have consistency in your results, right? If you can't determine whether you are a good or bad trader off of a single day, off of a single week, off of a single month. Really not even off of not only, really not until like a single year, but a quarter, 3-month period, that's a good period of time to kind of see if you got what it takes or not. Again, it's not to say all be all, but it's better than doing it on a daily basis or a weekly basis. So we tell traders, hey, if you can survive a quarter, if you're obviously sticking to your plan, you're taking good trades and your performance is replicating that, then what you want to do is you want to reward yourself with more money. So if you planned on starting with a $10,000 account, for example, just don't start a live account with $10,000. Start with maybe $2,500. And then after your first quarter, if things are doing good, reward yourself with another $2,500. And then after that next quarter, if things are doing good, reward yourself with another $2,500. That way, by the end of the year, you have a fully consistently profitable year. And now in year 2, you're trading your full allotment of cash. So he said, I added some money to my account in December 2019. As soon as I added the funds in January, and this is how it always goes, right? For you guys that have gone from demo to live, it always goes like this. As soon as I added funds in January, I hit my biggest drawdown yet. I had 2 pound pairs on at the same time with big stops, and they both lost. This is something I have noted and adjusted in my trading plan to include a new rule on stops from that type of exposure again. And then he attached some screenshots from his broker. I'll probably share some of that with you, not the whole thing because it's a little bit personal. But he says, as always, I can't thank you enough for everything I've learned from you. What type of advice do you have? And just to kind of give you a brief version of it, I said, first of all, congrats. 57% return is amazing. I don't think the drawdown, just looking at the stats, was that bad of a drawdown. I also don't know the trader's maximum risk drawdown requirements. But there were some concerns with immediately making a rule about reducing exposure on pound pairs, because that could be a double-edged sword. And what I mean by that is, it's easy to panic and have fear and say, oh man, I took two big losses at the same time. I should never be in two trades at the same time again. But before you make that decision, you have to actually look back at your previous performance and say, hey, how many times during the good period, right, the 50% return period, how many times were I in two trades that won on this specific currency? And if I were to remove that from my results, would it actually be a negative to my trading? So does the positive outweigh the negative? We always focus on the negative. It hurts more. If you think about bad periods in your life, those tend to stand out. Pain is a bigger trigger than pleasure. But we have to make sure we're not sabotaging the good in hopes of avoiding the pain. So I told him to look at that. But in general, I also said that one of the best ways to improve, I didn't think there were a lot of ways he could improve just based off the details he sent me. But I told him what I always look for when I try to improve my trading, and this is something that I've done over the years, is it's not necessarily, I have added ways of trading. I've gotten more aggressive, yet more conservative at the same time. I've added different techniques and tactics. I'm working on adding something right now on the daily chart. But in general, the thing that has benefited my trading the most has been addition by subtraction. And what I mean by that is working on risk management, and really two aspects of risk management. Becoming a lot better with my target projections. So becoming a lot better with my predictions on where price is likely to go and where I need to remove money from the market. Not getting too greedy and shooting for such a big move that I end up missing it and the market comes back to kind of, take my money or put me at break even at least. And then reducing risk. It's, hey, my theory is that I want to know when I'm wrong as soon as possible in the market. Right? You do need to have that buffer within your stop loss. You can't be so tight that you don't give the market enough room to breathe, but you don't want to have your stop loss so loose that you lose you lose too much to know you're wrong. So I want to be able to determine when I'm wrong quickly. That way I can cut my losses. And that was a lesson that was taught to me by my trading mentor, but it was also taught to me by a trader that I really look up to by the name of Peter Brant. I know a lot of people have different opinions about Peter Brant, but he meshes with my philosophy on the market really, really well. He's been trading for over 45 years. His theory is small, consistent returns. I think 40 of those years have been profitable. And it's not your sexy 100% returns. It's a steady 40% return a year or something like that. And that's kind of how I like the market. And I was reading something by Peter the other day. I think I'll get to this a little bit later. Here's some coming to trade commentary, some of the kind of the codes that he lives by in trading. We'll talk about this one a little bit later in the video. But two that really stood out to me is one, finding profits in the middle of the move, right? Not having the urge to catch tops and bottoms, not shooting for the entire move, just understanding that as a trader, we just want to take a chunk. We want to take our chunk and get out. I always use the bank robbery reference where it's like, hey, if you're robbing a bank or a jewelry store and you spend so much time in there trying to get every single thing, the likelihood of you getting caught increases by that much. However, if you're very specific, kind of like the Pink Panthers when they did it, if you're very specific, you go in, you get only what you need, you get out, you have a better chance of getting away with it. And especially as retail traders in the market, we're just trying to get away with robbery, right? We're not controlling the market. We're not making any moves. We're trying to follow the institutional money. We're trying to hop on a little bit of that ride and then hop off before we get burnt like many of the newer traders out there. So, that's something that's key. Another thing is aggressive risk and trade management practices as well. He says, I was lucky to have good mentors at the Chicago Board of Trade who drilled into me the idea of cutting losses quickly in order to preserve capital. So we're going to talk about both of those today. We're going to start with trade management, so reducing losses. And then in the second part of the clip, we're going to talk about finding profits in the middle of the move. So let's hop into a chart right now. Dollar Canada, because this was an example that we had during the week here. There's a trade. This was a trade that I really, really liked. Now, it wasn't one that I could take because there just wasn't enough room for profitability. But it was a setup where, I'd take it all day, every day, twice on Sundays. And of course, it ended up not following through because that's how, dollar yen, excuse me. It ended up not following through just because that's how my predictions went last week. They just, I think we're going to do this. I think we're going to do that. Didn't actually get in any of the trades because I never got the signal, but the market just, boom, wiped out our analysis and kind of left us hitting the reset button. But this is one that we looked at all week during the room, and one of our live room traders actually took this, and we were able to turn it into a good example of how to manage risk. So, this is an ascending triangle. Obviously, and what you're looking for here is a breakout. We talked about this in last week's video, looking for a breakout up to the 112.50 level. Now, obviously, we did not break out in that direction, and what's funny is the immediate response we get. I got this from some Twitter dude the other day where, he was asking me the question. He said, Akil, in my opinion, technicals don't work in these type of markets and blah, 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 blah. And I was like, well, in my opinion, they do. And he's like, and basically he screenshotted the video from like November and saying, see, in this video in November, you called this breakout and the market didn't do it. And like stuff like that is just the worst, because I think traders don't and this is one of the reasons I stopped posting the trading view a lot, because people just don't understand that there is a massive difference between making a prediction and making a trade. I hope you guys understand that. Anyone that's traded for any amount of time now seriously understands that you probably make, you make a handful of predictions each day in the market, right? If then thought process, IPDE, right? Identify, predict, decide, execute. Okay, I think if we go up, we're going to go here. If we go down, we're going to go here. I think we're likely to do this from this area, right? I would say that about 1% of the predictions that you make actually become trades. Because not only do you need to make the prediction, right? You need to make the prediction, which is what we're doing when we analyze the charts in the first place. But you need to make the prediction, and then you need the market to show you signs that that prediction is likely to come true. Then you need the market to give you your very specific entry reason. You also got to make sure risk and reward works out. You need all those things to align before you ever take the trade. And most of the time, they just don't, right? Sometimes the market moves in your direction, but it never gives you any confirmation. Sometimes the market moves in your direction, but it doesn't give you your specific entry signal. Sometimes the market just doesn't move in your direction at all, and you're like, oh well, guess I was wrong, and you delete your drawing tools. So it's very important to understand that as a newer trader, that you're going to make a lot of predictions, and a lot of your predictions are going to be right, and you never get a chance to get involved. A lot of your predictions are going to be wrong, and you never get the chance to be involved. That's just how the game works. But you want to keep making them, because every once in a while, you're going to get that opportunity where you make a prediction, the market gives you what you need, and those are the trades you have to take, because those are the trades that are going to help you extract your edge from the market. So this was a trade that broke out to the downside. I apologize for that little rant, but it's like, I wish people are just so silly sometimes. Especially, I love how they handpick stuff to make their point. And I guess educators do that too. I guess, I don't really follow anyone here on YouTube, but from what I hear from a lot of you guys, there are a lot of people out there doing videos or posting charts where it's only after they're right, and they're like, "Hey, told you." So I guess it works on both ends. But this was an ascending triangle, and it was a trade that one of our traders was looking at, or one of our traders was actually involved in. Again, it was one that we were looking at throughout the week. It was one that one of our traders was actually involved with, and he had a question about kind of risk management, because he had gotten to the point where he wanted to exit the trade because it was, it wasn't working at the speed he thought. I'll just give you an example. I believe, and I could be wrong, I believe the trader got involved down here. Somewhere, I don't remember the exact. I probably should have went back through our recordings and looked at it first. If you want, just watch the live room recordings from this entire week. You'll see. But I believe the trader got involved somewhere down here. And we'll just use this as a lesson. We'll say 110 because it's going to make a very easy lesson, right? Stops were below this level. I don't remember where his targets are at, but let's just say up here at 112.50, that same higher level of structure. If you were to look left, there's a big level of structure looking left here, right? So he's in the trade, and the trade's doing this, right? It's doing the bouncy bounce dance. It goes up. He's in the money. Oh, yeah, oh, yeah, oh, yeah. Then it comes down. Oh, no, oh, no, oh, no, right? Bounces back down to break even, right? And then it goes up again. Oh, yeah, oh, yeah, oh, yeah, oh, yeah, right? Then it comes back down. Oh, no, oh, no, oh, no, oh, no, right? And we do this dance the entire time. This is what forms the ascending triangle. And the trader was getting nervous because, we always talk about good moves don't last, right? Typically, if you're right on your call, it should go up there. It should go up to your profit level fairly quickly. So the more it kind of churns, the more you're like, maybe this is not the right move. But in this case, I told the trader there's no reason to be scared here, because even though it hasn't really rocketed up to your projected location, these are still positive signs, because this is what's called an ascending triangle. And what's happening here is, yeah, we're moving up and down, we're ebbing and flowing, but each time the price action moves down, right, the lows are getting higher and higher and higher. So this is still a positive sign for the bulls, for the buyers. So I wouldn't freak out. I would stay in the trade. Now, eventually, this ended up not working out. But one thing you could do in this trade, right, is risk management. We talk about this in all of our trades, addition by subtraction, right? Instead of taking a loss, right, 114 pip loss, right, if you're consistently rolling your stop losses up as you read price action, right, below the lows, below the lows, below the lows, and eventually, there's one more to come right here, right? Eventually below the lows. It's not going to let me drag this up, is it? Nope. Well, anyway, we'll mark it off here. Eventually right here, when you ultimately get stopped out on this type of deal, oh, boom, right? When you ultimately get stopped out on this type of deal, yes, you have a losing trade, but instead of taking your original 14 pips of loss, whatever it was, it's called 100 pips of loss here. Again, we're just making an example out of this, right? You actually make some profit. You actually make about 60 pips of profit because you are managing your risk on the back end. That is a very easy way to kind of implement that addition by subtraction philosophy that we talked about. And it doesn't just work for winning trades. Like sometimes on losers as well, you can reduce how much you take a loss, right? I'm working on back testing a strategy right now that Jason Greystone produced. And one of the things that I've been working on drastically is how to cut my losses short. It's on a daily chart, so there are some big losses on there, as you can imagine. So how can I take a 200 pip loss and make it a 100 pip loss? Because if I can do that, if I can take half away from my loss, or a third away, or a quarter away from my loss, right, it's essentially the same thing as giving myself a win. So the trader technically has a losing trade here, but instead of losing 100, he gained 60. That's 160 pip turnaround right there. So that's a good way to do it. Again, the other thing that Peter Brant mentioned in his update was finding profits in the middle of the move. Now, we don't talk about this too much because I don't personally implement this, but the other day in the live room, we had a conversation on how you can actively manage your targets as well. So do the same thing, but basically instead of reducing your risk, you're exiting the trade earlier. And I'll show you a clip from the live room of when we discussed it. It's pretty short. I think it's about 5 minutes. But this is why it's important, right, to know technical analysis. And I talk to so many new traders that they ask, okay, well, Akil, can you teach me technical analysis to be a day trader? Can you teach me technical analysis to be a trend continuation trader? Can you teach me technical analysis to be a pattern trader? Can you teach me technical analysis to be a counter trend trader? And my answer is, guess what? There's no specific technical analysis for any of those, right? Your day trading concepts are the same as your swing trading concepts. Your swing trading concepts are the same, or your pattern trading concepts are the same as your trend continuation trading concepts, which are the same as your counter trend trading concepts. There's no specific technical analysis per this type of trading. It's technical analysis in general. It's the ability to read a price chart. It's like being an athlete, right? I coach track and field. I was at a workshop the other day when I was presenting, and we had a good conversation on, look, we just need athletes. If you're an athlete, you can teach them the specific skills of each sport. But at the end of the day, if you're not an athlete, you're not going to be good at any sport. So the key is learning to read a price chart, learning the skills of making predictions, right? IPDE, being able to identify what the market is doing, using that identification to predict where it's likely to go next. And then what you want to do is you want to adapt that to your specific style of trading. Okay, well, how can I use this? How can I use this as a counter trend trader? How can I use this as a trend continuation trader? But the concepts are the same, and counter trend concepts are going to help you take targets if you're a trend continuation trader. Trend continuation concepts are going to help you find reversal areas if you're a counter trend trader. It all works the same, right? Ebb and flows in the market. You can't identify an advanced pattern formation if you can't identify a basic swing in the market. So you need all of those foundational elements to be successful. Sorry for that rant, but that was a bridge to get into, again, a little bit of a conversation we had in the live room about how to actively manage targets. So let's, before we get to this clip, do me a favor, hit that like button if you find this valuable so far. Hit that like button, leave me a comment below if you have any questions or you just want to say, hey, good job, Akil. And now we'll get into that clip. I have to do a little shameless promo first. Another question coming in. Akil, I understand it's okay to change stop loss during a trade if price action is giving you a reason. Is it okay to change targets? Well, it's okay to change stop loss for the positive. So it's not okay to move your stop loss back. So I just want to, for any new trader listening, it's okay to do active trade management. So you can reduce your stop. It's not okay to move it the other way around. Do not widen your stop. That is no better than going down to the minute chart and becoming the market's lunch. But yes, moving your stop as long as it's rules based is perfectly fine. As far as moving your targets go, it depends on your technique. I would say, so here's how I would do it. For me, it's a no. I don't think there's any reason to move your target. I just don't see any scenario where there would be any point of changing a prediction, because nothing is going to happen to nothing is going to happen to the previous point where your target is at. Now, the only time I would say this, if you are an active trader, and meaning that maybe you manage your trade based on current price action, then it's okay. So here's what I mean. So let's say we're taking this trade here. And again, I don't do this, but I do understand that this is a play. So let's say that you're taking a trade. Let me write this down. What is active target? Active target moving. Active target moving. So let's say you're long here because you're awesome, and you've identified a zone, kind of like what we did with the head and shoulders yesterday on New Zealand dollar. You've identified that you want to take targets somewhere in this zone. All right, let me know if you guys follow me so far. Right, and this is the zone. If you see, I measured it of the zone of this big wick. Now, you don't know where within this zone you want to take targets at, right? You don't know us. Maybe you drew out some fibs and you have an idea. So maybe let's say you did something like this. You said, I'm going to take targets at, the 886, but because you're an active trader, you're allowed to remove targets anywhere in that zone. And this is why I say you need specific rules. So market's doing its thing. It's coming up, it's coming up, it's coming up. And then let's say you get a negative signal. And again, this should all be within your rules. This is predetermined. This is not something that you do in a normal trade. You've predetermined that this is your style of trading. Like, I want to just emphasize that massively. I do not do this. I stick to my targets. I believe in making that prediction beforehand, letting it play out until one of two things happens. I hit targets or I'm stopped out. But we know there are millions of ways to trade. So let's say price action comes up here, and then we come here. We don't get your targets hit, and we do something like this. We do something like this. So this is what I would call these are two negative candles, right? This would be no different than what? Can you guys hear me? Hello? Mic check? Okay. This would be no different than what? It's not a trick question. Yeah, basically a 3-bar reversal, right? Which would be a signal for a buy or a sell. So you can do a technique where you hold on, you have the option, kind of like a graceful exit. You have the option to, once price, and I would do it once price action is in a specific zone. I would have to measure out a specific zone. And then if price action is in that zone, if price action is in that zone, then I look for a reversal signal. If I get reversal signal, then I exit at market. So if I were to get this within my zone, right, and this is key, it's not just like nervousness, you have a predetermined zone. This is a bearish signal, right? This is a reversal signal. You would think that the market would then reverse. So you can exit your trade at market based off that signal. Does that make sense? Even though it didn't hit your target. So that is a way you can do it if you want to actively do targets. Now, change targets. Now, in your situation, you said, is it okay if I take a partial position off at a higher level of the triangle and then a remaining level of a remaining position at higher structure? That is okay. Yeah, that's fine. But the question is, was that, are you already in a trade? All right, so before we hop back into today's lesson, I want to take a quick second just to promo an awesome video that my business partner, Jason Greystone, just shared on YouTube. You see, last year he hosted this awesome event called the Trader Vault, which featured some of the world's best traders, answering questions and just delivering insights on what it takes to be a seven-figure trader. There's actually supposed to be another live event this week, or not this week, but in April in Amsterdam, but because of the whole coronavirus thing and the ban on travel into quarantine, that had to get pushed back until October. But what Jason decided to do was put last year's event on YouTube for you guys to check out. So I'll throw the link underneath in the description box of this video for you to check it out. And trust me, you're not going to want to miss it. It's pretty long, so be prepared to take breaks and be prepared to take a lot of notes. But it's the perfect way to spend kind of your quarantine time or your time away from the charts, which is learning from the best about how to become a better trader. All right, with that being said, let's get back into today's lesson. So I want to talk about one more thing before we leave here today. And I bring this up because we're probably going to revisit the daily chore strategy in Monday's Q&A for you guys that are on the Tier 1 trading platform as premium members, right? If you guys remember, we did a review session on it 2 weeks ago, and then last week we actually talked about building a trading portfolio and what I look for in my pairs as far as performance, and we showed you guys kind of the different type of equity curves. And you know, just because something's profitable doesn't mean it's a good pair to trade. And I showed you kind of my ideal equity curve, the slow turtle-like move from bottom left to upper right. And we're going to revisit the daily chore on Monday most likely because I have been testing some more filters. It had a good result on one pair, a poor result on the other pair, so there's no conclusions to it yet. But the concept that I'm using to trade it, or the concept behind adding the filter, is really based off of one of Peter Brant's rules right here as well, which he says, I'm committed to a reality that 10 to 15% of my trades will produce my bottom line over an extended period of time. And what that means is basically this. A 10 to 15% of my trades are what's going to produce my profit, right? So the majority of the trades are either losses or they're break even. I think there's another one in here right now. I have no compulsion to make money day in and day out, week in and week out, month in or month out. In fact, the net of my career trading profits have come from no more than 20% of my trading months. And what this basically means is that trading is a game of survival. We've mentioned this before, right? If you come into trading, right, with the idea that you're going to make profit every day, if you have a specific profit goal for every day, you're going to lose. If you believe that you're going to make profit every month and you're never going to, or every week, and you're never going to have a bad week, you're probably going to lose. Right? You can say the same thing for months, right? You know, hopefully most of your months are profitable or break even, but you're going to have bad months as well. It happens, right? It's all about the long game. What this is saying is that trading is basically surviving until the next boost, right? It's basically risk management, right? Surviving, taking your losses, keeping your losses small so it doesn't put you into too much of a deficit of a drawdown in your account, and then surviving to catch that next big winner. And especially if you are a trend following trader, this is going to be your type of game, right? I'm more of a counter trend trader, so you know my theories are a little bit different. I'm kind of in and out. But if you're a trend trader, it's very similar to Richard Dennis and the Turtle Traders, where it's like, hey, you may have to lose a handful of trades in a row, but when you catch that big winner, it's going to make up for all of those trades. It's going to make up for the previous day, the previous week, the previous month, assuming you don't sabotage it and take your profits early. And I think it's important to understand that. And that's something that I've implemented in this latest round of testing for the daily chore strategy, is really, instead of kind of an get in, get out approach like the traditional rules, it's more of a, hey, survive, 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 catch the big move in the market. I even showed you that from the previous strategy I was working on, where it's like, hey, these markets run sometimes where you can catch a 200 pip move, a 500 pip move, a 1,000 pip move. It doesn't happen all too often, maybe a couple times a year. But if you can survive long enough and not blow your account, right? Just keep your head above water and then capture that move. That's all you need for the year. That's all you need for a year. Now, easier said than done. Now, I don't want you guys thinking that, hey, I'm just going to go out there and capture the big move, because again, you have to be prepared, right? If you're not consistent in your routine and prepared each and every day, you're going to miss that move. And then your losses are just going to pile on each other. So, it's not easy. It's difficult psychologically, because in most cases, you're going to have a smaller win percentage. In most cases, you're going to have maybe a lot more break-even trades. You're going to look back and say, man, I could have made profit here if I just would have taken, the hindsight stuff. But for those who are disciplined and follow the plan, it could be a great thing, especially on a strategy that only requires that you check the charts once a day. And I know you guys on YouTube, you probably have no idea what the Greystone daily chore strategy is, but I believe we're going to teach it in the upcoming Ascension webinar. So if you planned on joining us there, April 6th to April 9th, I believe we're going to teach you that strategy during that workshop. I don't remember 100%, but I think that was on the to-do list. Typically we set a to-do list and then we ended up just changing it based on what you guys want to talk about, but I think that was on there. So don't freak out. You'll learn about it in about a week. So just hold your horses a little bit. But for you guys on the platform, we've been doing a lot of work on this. We have that group, which has been amazing. Lots of cool ideas on there. And again, that's just a different approach that you can use to attack that strategy. But I think it's cool. And again, if Peter Brant has a book, and it's not a book that I typically recommend, because most of the time when I get asked about book recommendations, it's from newer traders, and I try to give them the books that I think would benefit them most as a newer trader. Like, a Market Wizards is a must read, a Trading in the Zone is a must read, stuff like that. But a good book from Peter Brant is called, it's Diaries, I'm going to butcher the name, I think it's called Diaries of a Commodity Trader. And it's a good book for experienced traders to kind of basically get a hands-on look at what it looks like to be a consistently profitable trader. The good, the bad, the exciting, the boring. It's a very good read, especially if you want to understand kind of how intuition starts to play a bigger role in your trading as you get more experience. So if you're an experienced trader, check out that book. It's a good read. Again, I'm a little bit biased because I like Peter Brant. I'm a fan of his. I've actually spoken to him a few times, and he knows who I am, and he likes my philosophy on the markets. But great book for you guys that are kind of experienced traders and just looking for kind of the next step in not only technical analysis, but mindset as well. So that's it for this week. I hope you guys enjoyed it. If you do, hit that like button. Please share this video. Leave me a comment below. I know it's not your traditional Trading Edge video where we're looking at charts and giving you ideas. So I'm sure there's a certain group out there that's going to be like, oh, Akil, this was a big waste of time. You didn't give me a trading idea for the week. But there's just nothing out there. And as we mentioned in last week's video, right, times like this, there are a few things you can do, right? You can either continue to trade as usual. You can trade with reduced exposure to the market, or you can stop trading. And I know a lot of people that have stopped trading until kind of the dust settles. And when you stop trading, it just doesn't mean just do anything with your life. Use this as a period to work on something else. Use this as a period to back test. Use this as a period to do some strategy development. Use this as a period to critique and review your trading and see how you can improve for the future, because the future is going to be fantastic, right? The future is going to offer a lot of opportunities. This is a prime time to be in a position where you know how to take advantage of it. So I know a lot of the traders on the platform here are dug in working on sharpening their trading skills so that they can do so. So it doesn't matter. If you didn't like it, you don't like it. I don't really care. But hopefully you found some value in this video for you guys that are going to go on to be consistently profitable traders, for you guys that do have the serious mindset. And I'll see you guys next week with another edition of the Trading Edge. Tier 1 members, I'll be on the platform testing. And of course, I'll see you in the Monday Q&A. So shoot those questions in so I can develop a lesson. All right, until then, plan and trade, trade your plan. Take care.